Welcome to part 3 of our financial statements video training. We begin this video by discussing the current asset prepaid expenses. That will be followed by an introduction to 3 asset classifications: current assets, investments, and property, plant, and equipment. Please print the PDF handout shown below this video as it will be used throughout the training.
Okay, prepaid expenses. So these would be costs we paid in advance. The classic is insurance. We get a premium notice, it's for 6 months of insurance, right? So let's say on March 20th, I got the notice for the next 6 months of insurance, April through whatever, 6 months. I pay for it in March, but none of it is used up in March. None of it expires in March. So rather than expensing that whole insurance payment instantly in March and distorting my financial statements for March, I'm going to defer it, we say, and I'm going to list it as a current asset. And then each month, I'm going to move 1/6. If it was a 6-month premium, then every month I'm going to move 1/6 of it out of this prepaid expense area and stick it on the income statement under insurance expense. Okay? So that's what's known as adjusting entries.
Okay, let me make sure I understand.
Sure.
This prepaid expense right here is the whole total insurance amount for 6 months, but using that as your example?
Well, it's the, yeah. So the question is the $11,200 the total amount that we paid for insurance for the next 6 months? And the odds are it's not. Because every month, of course, this is going to go down by 1/6, and there might be some old policies that are in here, and there might old policy premiums that we paid at a different time. So they might not all be coordinated. Or maybe we paid a huge fee to our trade association, and it covers the whole year, and we didn't want to sit that whole big one payment into 1 month's income statement. So we deferred it instead of as a prepaid. It's covering our membership dues for the whole year, and then each month we'll move 1/12 of that annual thing out. So we don't know that it's just one item sitting in there, right? So in my case, under my explanation of, or my example, it would all have to be in there right now because we wrote the check on March 20th or so, and it's for the April, the period starting with April. So in my example, all of that has to be in there.
Okay.
Now, next month, it's going to come down by 1/6, and the next month it'll drop by another 1/6. And at the end of 6 months, it'll be pretty close to 0, right? And after 5 months, it'll be 1,000, but then I might pay the next 6 months, so it's going to be hard to tell exactly. Okay. All right, so we're now going to look at the total current assets. So we sum up those 5 items there, and some people would say that's the amount of liquid assets. What the bankers and others are going to do are they are going to compare that total current assets amount to the current liabilities, which we'll see later. And if that'll tell people like your bank, here's how much cash they expect in the next year, and then they're going to look at the current liabilities to see how many dollars have to be paid out in the next year. And if a company has more current liabilities than current assets, boy, that's bad news, right? How are you going to meet the payroll? What are you going to do? And of course, that's a general ratio or rule. What we really have to do is look into these individual amounts here, right? I mean, if we have inventory of $350,000 and 100,000 of it has never moved in the last year, what are the odds that is going to move, right? So we have to be careful, right? And the accountant is supposed to help us by saying, you know, if it isn't going to turn to cash, I'm going to have to